The Morgan Report with David Morgan.
Welcome, everyone. This is David Morgan with the weekly perspective for the week ending 28 June 2019. Well, let me start off as I usually do with the stock market. And I have noticed and reported that the stock market, the general equity market, referring to United States markets, really have been somewhat weak. And this week ending today, the transportation index just cleared the 200-day moving average. So anyone that knows a little about the Dow theory knows that the transportation has to confirm the industrials, and the Dow Jones transportation has been really falling all year long, and the industrials haven't done much better. So the Dow theorists have been pretty worried about the situation, but they are rising together. Are we going to get another run up and make new highs in the Dow? Remains to be determined. I'll just leave it at that. I'd say that the stock market, U.S., is in an indecision pattern. It really is fairly volatile, and the breadth has gotten better. But overall, I'm skeptical of any significant change in the stock market to the upside. And for those that are new coming to this, I'm on our landing page, so be sure that you go ahead and give us a first name and an email, and you have to verify that to get on our free email list where you get these weekly updates and a lot more during the week. Once in a while, I get an offer. If you don't like it, just move on. So moving on to the news of the week has to be the gold market, but I will get to that later in this presentation. All right, so we're back with Bloomberg. Trump warns of Plan B on China, billions more in tariffs. Basically, all eyes are focused on the G20 in Japan. Will Trump and Xi Jinping reach an agreement or smooth over this quote-unquote trade war remains to be determined. I think markets will react somewhat. I think they've built in some of the anticipation already. It remains to be determined. And so much depends on the housing market, especially the United States, but really, I just read recently, if I've got the number right, I think it's 40% of economic activity has to do with construction. And this could be, road construction, building construction, water, dams, anything that has to do with construction. And that makes sense to me. But anyway, this is focused on housing from Market Watch. Out yesterday, a housing market slump could drive global growth to a decade low, economists warn. And this is global housing market is showing cracks. Those fissures could spread throughout the worldwide economy, potentially sending worldwide gross domestic product, or GDP, to its lowest annual pace in 10 years, according to the research from Oxford Economics led by Adam Slater and John Payne in a research report dated June 24th. I have not read it, but I do think there's a lot of distortions in the housing markets. In fact, there's distortions everywhere. Why? Because of easy money. Why is the easy money there? Because the only way for the banks to stay solvent is to keep printing. And the only way you can get interest payments to pay off credit is to increase the money supply, because when the principal loan is made, the interest isn't there to pay it back. So it is one great big bubble that has to continue to inflate. But anyone watching this update, unless you're brand new, would probably know that already. Found this one on Yahoo Finance. UBS, world economy one step away from global recession. Well, the Morgan Report and many others have been telling you about recession is almost a guarantee with the yield curve in the way it is the longest recovery on record, a record high stock markets. Why? Because, or I should say equity markets in the U.S., because of stock buybacks and other shenanigans in the financial paradigm that we currently find ourselves in. But moving on, the article. The world economy is on the leading edge of a recession, UBS said on Monday, which could prompt all major central banks to ease monetary policy in response. Wow, surprise, surprise, how rare. The U.S.-China trade war is amplifying fears of a global downturn, which according to the UBS means Donald Trump may get his wish for the Federal Reserve to cut interest rates. Thus far, the world's two largest economies have not been able to strike a deal to end the trade dispute. An additional $300 billion worth of tariffs are currently on the table. So here we go. More rhetoric about the problems that we face. And really, with the interest rates where they are currently, there's not a lot of room to cut. Yes, they will cut, and bond investors that hold bonds will reap the benefits because lower interest rates means higher bond prices. And wow, made money in the bond market. But it can't go on forever. And what do you do when interest rates are zero again? And what if they go negative? I mean, there's so much out there that's so distorted. I don't think we have a lot of time left, and I think gold is starting to show signs of knowing what's coming, so to speak. And I'll get to gold in a moment. I have a couple more articles I want to point out. Just got to put in my 2 bits about Bitcoin. It certainly took off recently. It based at around the 3,600 level. I did a webinar, still valid because all it talks about bases of markets movement and areas of resistance, and once it breaks certain areas, it will accelerate, which it's done. And so Bitcoin has been booming up, and then it fell back, and now it's recovered some as I'm making this video. But can you say the word volatility? But if you look at today's close of roughly 12,000 and base it around 4,000, I mean that is a pretty significant gain. And I'm just showing you a weekly chart. If we look at the monthly here really quickly, you can see this price spike and then this fall back and this burst back up. And of course, if we take a look at a year, it was basing in here, 37, 34,000. As I said, I'm kind of rounding it up to 4,000. And then it took off, stayed around the 5,000 level for a while, broke up, immediately went up to basically 8,000. And it stayed in that level for a while. And then boom, it really made a move, as I'm showing you, and now it's backing off. But not for the faint of heart, but Bitcoin enthusiasts are certainly happy this week. I want to briefly talk about energy. I do write a energy report, and I don't want to dwell on that, but this is an interesting one from Reuters. Weaning U.S. power sector off fossil fuels would cost $4.7 trillion, according to the study. Reuters eliminated fossil fuels from the U.S. power sector, a key goal of the quote-unquote Green New Deal, backed by many Democrats, would cost $4.7 trillion and pose massive economic and social challenges, according to a report released Thursday by the energy research firm Wood Mackenzie. This would amount to $35,000 per household, or nearly $2,000 a year for the 20-year plan, according to the study. The report is one of the first independent cost estimates for what has become a key issue in the 2020 presidential election, with most Democrats proposing multi-trillion-dollar plans to eliminate U.S. carbon emissions economy-wide. And I won't read the rest of it. Rather significant to pull this off, and really not the best way to do it in my view. I'm not a huge oil proponent, but there's ways to do things that are more efficient than others, and just because this sounds good perhaps to several without understanding exactly what goes on, it should probably read not only this article, but do a little bit of really good study and research and look at both sides. But there's a lot to this, and it's not an easily accomplished task by a long shot. And with gold, I could probably spend a half hour talking about it. I am going to briefly go over Jim Wyckoff's article here on Kitco. I was interviewed on Kitco that came out today on Friday, the 28th. If you want to find it, just type in David Morgan Kitco or Kitco interview. You'll probably find it. I take a longer term perspective. Jim usually looks, short term. Does great work. No ifs, ands, or buts about it. So my 2 cents or more is that we have reached a huge overhead resistance at around a 1350 basis US dollar level for 6 years. Gold is the highest, had about the best few weeks it's had in about 3 years. We've got up to about 30 and change in the aftermarket, or what we call the Asian markets, a few days ago, a few trading sessions ago. Now we're backing off. Gold is trying to find a consolidation level, which it has not established yet. But I am pretty convinced, or more than pretty, I'm almost certain that we have finally reached that barrier, that 1350 barrier, and we are in new territory, which means we are back in a bull phase, and it should last quite some time. The only thing that would persuade me that I'm wrong is to see it under 1350 and stay there for quite some time. and I don't think that's going to happen. Silver really hasn't confirmed gold's move, although it moved up. The gold-silver ratio is really very advantageous for anyone willing to take the extra risk of buying silver. And, of course, there's always that swap trade that's available if you're so inclined to buy those 92 ounces of silver for every ounce of gold that you want to buy. And then when the ratio drops down to, say, half of where it is now, or 50 or 45 or whatever, you can swap that silver into gold and own twice as much gold, or it'd be like buying gold at let's say $700 an ounce, which isn't a bad price to buy gold. So, going on with Jim's article here, he basically says, tensions in the Gulf and everything that's driving it. The bulls are still in the lead, and technically, still favoring gold for the long side. July silver future bulls overall have the technical advantages. Prices are on a 4-week overall uptrend on the daily bar, but barely. Bulls need to show fresh power soon to keep the uptrend alive. So all these markets move on buying and selling, and basically it's buying and selling of contracts, not physical gold. Nonetheless, the buying pressure has been rather substantial, and obviously, the move in gold again, I think, is going to be confirmed as far as being the start of something good for precious metals investors finally. A brief reminder that a new Morgan report will come out this weekend. We have updated Pan American Silver, which is one of our holdings, which is one that if you're a silver guy or girl or investor or hedge fund, certainly kind of hit the bargain table because of their situation with the Tahoe mine, which we think is going to longer term be quite advantageous to the company. We think that the stock is at a low. I bought some recently, full disclosure. It's up. I'm up on it already. I think it's still in a good buying zone. We updated another company that we have really like as far as a speculative situation. We updated our favorite speculation. David just made another trip to the facility, got hands-on, and we talked to the management about my questioning the ability to work with the REE, the rare earth elements. And we didn't get a lot of data, but we did put it into the report. And the main bulk of the report this month is my interview with Mr. Hugo Salinas Price. And if you're not familiar with him, you can go to a search engine and type in Hugo Salinas Price, who is, without a doubt, in my view, the seminal proponents of silver. I mean, much more than yours truly. He has started a pro-silver foundation in Mexico many years ago and has proposed in several arenas for several years to allow silver to be traded as money alongside the Mexican peso, and he's also said it could be accomplished in Malaysia or other places. So I wanted to do an interview with him regarding his current thoughts on not only silver and gold, but the economic situation, how long it could continue, what he thought of manipulation, and on it goes. So it is an interview that if you are so inclined and you are a paid member, you'll be reading that this weekend. And I will leave it at that for pitching the Morgan Report. Okay, so I mentioned gold, and now I'm going to finish off with silver. And this may take some time, so if you don't want to hear it, end the video or the podcast at this time. So this came through on a Twitter account, and this gentleman said, "Hello, Mr. Morgan," and he's from Belgium, so his English writing is better than my Belgian, I'll tell you. But anyway, I'll try to make it as best as I can. Because of the high gold-silver ratio, I invested 80% in silver, 20% in gold. Now the ratio continues rising. What do you think the ratio will do when there is a monetary reset, and why? Thank you for your answer, Frank. I won't pronounce his last name, which I would probably butcher anyway. So I thought I'd take that on this week for this weekly perspective. And those that are on the video can see the extra pyramid. And I was one of the few to bring this to the fore back when I started on the speaking circuit 20 years ago or so, when the precious metals was just starting their bull market. And first person I actually got in a big discussion with about this was Jay Taylor. And then he was friends with Ian. I forget his last name, forgive me. That was a big deflationist. And it kind of took off from there. It kind of made the circle in the precious metals community, and it's very popular from time to time. Run the Gold has a graphic of it. I've taken this one from this website here. You can see where my pointer is at. And basically what it shows is all the money and assets in the world in physical $100 bills. And then it shows some relationship, like where I'm pointing now is the Statue of Liberty. So if you had pallets of $100 bills, that's what it will look like. I'm not going to go through that much. But what the extra pyramid is called a liquidity squeeze. And it's upside down because it goes from the least liquid, highest risk situations in the monetary universe, our monetary universe, to the most solid, most liquid, highest coveted asset that there is, which here is gold. And there is a graphic with silver at the very tip, which I tried to find, I could not. So as the things unravel for the reset, everyone works down the pyramid. So derivatives, to sell what you could get, probably will lock up that system. No one wants them. And there'll be quarrels about what the derivative contract really says, and on it will go. But this is the least liquid place, and that's why something like Deutsche Bank that has such, I think it's 10 years worth of GDP, of German GDP, worth of derivatives. I mean, something insane like that. Anyway, next down is the private businesses and real estate. That's at the time this was done, $300 trillion market. Then you've got securities debt of about 100 and, if I can read this, 16 trillion. Government bonds, which is about the middle. Bank money, base money, which is your physical dollars. Then that's the run to the dollar. And of course, this is where you would see people and institutions in a monetary panic, reset, currency crisis, what have you, you name it. The drive would be for safety. And most people would think of safety as a physical note of some kind, whether it's a euro note, or it is a yen note, or it is a US dollar note, whatever. Anyone that's in a country such as, say Iran or Argentina, or some of the other countries that are noted for currency crisis on almost a decade by decade basis, like Argentina, probably would want to exchange their currency for US dollars if they could. So there'd be a run to the dollar. And that's why I continue to say that during the reset, or as it's happening, or prior to the completeness of it, or completion of it, I should say, there will be a run to the dollar and then a run to gold, probably at the same time. Gold and the dollar, US dollar, will both be going up. And this will drive some people nuts because they think, well, the dollar and the gold move opposite. Not always. In fact, in a liquidity squeeze, you can see they're both the safest, most trusted asset. The problem is that the dollar can be printed at will, and the inflation will probably be high enough. I doubt hyperinflation is possible. I don't rule it out. But enough inflation, enough debauchement of the currency, enough devaluation of the dollar, enough uncertainty, enough fear that people will move from getting those dollars into what's really doing well, and that would be gold, and lastly, silver. So what will happen to silver in the reset? Well, gold will start because this is a bigger market, well-known market, and believe it or not, more of an establishment market. Banks still hold gold as a monetary asset. It's a tier 1 asset. And even though it's not talked about favorably by banks most of the time, it really is coveted by banks if you were able to put them on a lie detector test. It hasn't failed. All paper currencies, and I repeat, all paper currencies have failed throughout all of recorded history. I don't think the dollar is going to be an exception. Does failure mean absolute zero? It does not. Failure means failure to have the confidence in it anymore. And when enough confidence is lost, then the whole financial system starts to unravel, and there's usually a reset of some type, which means a repricing of almost every asset out there, and a lot of readjustments in the financial sphere, which with what's going on now, with derivatives taking such a huge portion, you could see as an example, this is an extreme example just to get you to think, no more derivatives, period. That's just an extreme example, but that's That's just for thought. So when gold starts to move, everyone will be, not everyone, but many people will be in fear, be it, private individuals, family offices, wealth managers, sovereign funds, nation states, you name it. And there will be this run to gold, and then there will be a spillover into silver because gold will be outpriced for a lot of people to be able to buy it. And since the silver market is so small and it's a liquidity squeeze, people are going to what they trust. And silver has been trusted more often, more places for more transactions than any other asset in the world in all of recorded history, and that's a fact. So silver will catch the benefit, and since it's a small market and much more affordable than gold, what will happen is silver will start to overcome gold on a gain basis percentage-wise. In other words, silver will gain in terms of gold. Instead of being 90 ounces to buy an ounce of gold, it'll take 80, 70, 60, 50, 40. And I think if this run to gold, this run to confidence, this run to trust, takes off in a way that it started in the early 1980s that I was a part of, I believe it will set a new record, meaning that you could see a ratio better than the 16-1 it hit intraday in 1980. You could see it go to 10-1. Am I predicting that? No, I'm not. What I'm saying is that the ratio is out of whack here. So most people are not convinced, silver is even worth owning. It's really not a monetary asset, and on and on. It certainly can hold that belief. But people that don't believe there'll be a lot of people right now that don't believe in gold. That, it's a barbarous relic and all the nonsense that you hear out there in the mainstream financial media. And they will just bypass gold and continue to. It's not, things that Buffett says about gold, on and on it goes. Until they have that moment where they realize that the system at large has been one great, big, huge Ponzi scheme that's failing in front of their eyes. And when that realization takes place and they start to get fear that everything that they own, every asset they have is not real, they'll go for the most real asset of all time, and that will be gold or silver. And when you see this monetary display that I'm putting on this graphic here that has been so nicely done, you can see how much paper there is versus how much gold there is. So it will carry over to silver, I'm convinced. I don't think there's any reason, I can't think of any reason it wouldn't. There's some that right now, things are still, chugging along more or less, pretending everything is okay when it really isn't. And, this G20 meeting is going to resolve all these problems that we have, and on it goes. Well, good luck with that. It may give that appearance for a while, but the reality is there's too much debt. You can't solve this debt problem with more debt. The only two assets that will be able to come out, no matter what, are, I should say only two, the two monetary assets will be gold and silver. Platinum and palladium will do well also, but there's assets out there that certainly could be worthwhile owning. Example would be, if you have a lumber yard, for an example, owning sticks isn't a bad thing. Any hard commodity, really. Food, of course, will be very important. I think this major inflation that we're going to see will start this year, near the last half of the year, mainly in food prices in the U.S. And this is one thing that the United States consumer will notice and will start to question why we haven't hit this 2% inflation target that the Fed keeps talking about. My food prices are going up a lot more than that. What's going on? So I said I'd be long-winded. I hope that I answered your question. It was a good one. If I could make it succinct, when there's fear in the markets, to go to something that's absolutely trusted, it'll be gold first and then silver. The market will perform. And when do I see this? And that's the hard one, and I don't know is the answer. I'd say we're probably 3 years out. Gold has just started a new bull market. It isn't going to take 10 years to go from the $250 gold or so that went up to $1,900 that took, like 11 years. It'll be about half or a third of that duration. So if it was 11 years, half of that's 5. A third of that's about 3. Usually the last leg of these major moves are usually much stronger in appreciation, like triple. So if you went from $200 or 250, I'll make it 3, so I can do it in my head real fast. 3 5s, 3 6s is 18, so 6-fold conservatively on gold. So you get something like triple that on the next move, which is hard to believe, but usually that's kind of a rule of thumb. So I think we got a big move in paper terms. Doesn't mean that gold is like that valuable in today's money. By the time it gets there 3 years from now, that level of fiat may not be, it won't have the purchasing power that amount would have today. As the fiat's debased more and more, it will still buy. I don't think the dollar's going to absolute zero, as I said earlier, but it is going to deteriorate fast enough what people want out of it. And as the bond market really struggles, as it will, because it's going to be illiquid at some point in time, where you're going to see interest rates forced up because no one wants the bonds, and the only way to get them sold is to discount the bond price, which means interest rates go higher. And that will be the market itself doing that. The Fed has had so much control. All these markets have had so much control for so long. But somebody out there, and I'm not the only one, believe me, that knows what's going to happen and knows it cannot be forced no matter how many algorithms you got and how much computer power you have. The market, as I think Craig Hemke says, there is a mother nature in the financial markets as well as a mother nature in nature, and this will take place. So I'll leave it there. I'll be back with you next week with another update. If you're so inclined, if you're not on the free Morgan Report, go to morganreport.com, get on our free list. There's a YouTube channel. There's a Twitter feed. I think there is a Facebook presence that's pretty minor. And if you are interested in making big money in this next move up, you want a balanced portfolio in the resource sector, you might consider a subscription to the Morgan Report. It's $500 a year, which at today's level, as far as the competitor prices, it's really a bargain, especially from the fact that I don't only do a once-a-month letter, but I do all these updates during the interim parts of the month as the markets unravel or move one direction or the other, to keep everybody informed and take action accordingly. So that's it. I'll be back with you next week. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources, from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter: to-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets, and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You'll understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means
My mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.